As senior specialist with the World Bank Group at Washington, D.C. But today I'm joining you from Kampala. It's wonderful to have you all with us today. And this webinar is something many of you are familiar with. This is in the nature of an annual update on infrastructure project finance trends in 2000 and in every year annually, and this is for the annual update for 2016. And today we have with us Gavin Munro, who's the managing director of Societe Generale. He's based in Hong Kong and focuses on transport infrastructure and PPP transactions in the Asia Pacific region. Earlier, he's worked in Europe and in South Africa on a range of infrastructure project finance deals. Gavin has been giving us what is in the nature of an annual update, as I mentioned, each year for the last couple of years. We had the first one in 2014 around this time, and another in 2015, again around the same time, that was late November last year. This webinar is his third annual update, and today we will be talking about what is happening in the project finance market in infrastructure globally, with focus on a few cases which illustrate either the dominant trend which is on right now, or projects which are themselves quite innovative and considered trendsetters in the market. So he will have a couple of those cases for you. It's so good to see all of you in large numbers. We had about 350 participants registering for this webinar, which shows the degree of interest in this area. Infrastructure project finance in and of itself is a fascinating area, but it becomes what can be called mind-blowing when you look at how a variety of very different assets, big and small, with transformative effects on society and our way of life that can be built through project finance without totally messing up government budgets. Of course, all of this is possible only if the projects are well structured and bankable. And talking about structuring of projects and what is a bankable project, we have seen, perhaps not strangely, we have seen the definition of bankable becoming narrower and narrower in the last few years. Banks have continued to be pretty hesitant to take on a high level of risk in projects, and this has given rise to a class of PPP projects that are highly de-risked. On the overall performance of the project finance market, the picture has been pretty non-uniform. You will hear the details from Gavin shortly, how different regional markets have behaved, what significant changes have happened over the past 11 to 12 months, and which are the countries that stand out either in terms of an increase or a drop in volumes or number of closed deals, as well as what is significant in the type of projects, including PPPs, that have been more frequently observed as being popular with the investors. Above all, there's this question of why some markets have shrunk. Some of them have, and while a couple of them have shown impressive growth. Why these differences? These are some of the things where there are subtle nuances which not even all of us who are public-private partnership specialists or consultants working on projects understand. It's people like Gavin who have been in this area financing projects in different areas who really understand this, and he'll tell us to what extent he himself understands how markets behave very strangely sometimes. A key topic that Gavin will also address today during this presentation relates to brownfield projects. Is there a new fascination that we see there? Brownfields have always been considered safe projects, given the immense amounts of knowledge and information that the public as well as the private sectors have on projects already operational and providing services. There's the question of demand, actually, which is very tricky in projects, and especially transport projects. But in brownfields, you have a history. So they are seen to be safer, but they come with their own problems. However, in the middle, you would have seen there seemed to be a longish period in which, when greenfields were encouraged and a large number of new deals were signed, governments were very interested in going out with brand new projects, squeaky clean, brand new projects. Gavin will look at both sides of the picture. Like I said, what are the good things brownfields can bring and what are the not so good things. He will also walk you through a couple of case studies, as I mentioned before, and these would be the projects of the Victoria Outer Suburban Arterial Roads Program and the LaGuardia Airport Terminal B redevelopment project, which is in the US. We will also give you, our participants, a chance to interact, because that's the best part of any webinar, where we understand where you come from and what you have seen in your regions as practitioners. We will have a 30-minute presentation by Gavin, followed by a question-answer session, and let's take it from there. Over to you, Gavin.
Well, and here again, everybody. This does take the form of a general update, and what I've generally chosen each year is to try and pick up a sort of interesting development that we're seeing in the market that I can sort of talk to you about and perhaps get some discussion going on about it. So this year, what I think is quite an interesting development is the resurgence of brownfield infrastructure projects. If you can just flick over to the next slide. Do I need to page down or yes? Just to talk you through it, I'll give a quick market update to just give you an indication of what we're seeing happening in the market. Then have a brief discussion of brownfield infrastructure projects in terms of what do we mean by them, and having a look at their particular challenges associated with brownfield projects. Then look at this new project which the state of Victoria in Australia is launching, the Outer Suburban Arterial Roads program, which I think is an interesting development and could be a new benchmark for these sort of projects going forward. And then lastly, look at a case study which my colleagues in the New York team advised on, which was the development of a new terminal for LaGuardia International Airport in New York. Right, then looking at the let me just right, the overall trends that we've actually seen in infrastructure, and you can see very clearly in the graph on this page, is perhaps somewhat surprisingly, there's a general downturn in the market. The number of projects being financed has been stepping down, and why I think that is surprising is because we keep hearing about the incredible need for ongoing infrastructure development, and then you have organizations such as the World Bank, the Asian Development Bank, and other public sector bodies coming up with estimates of the amount of money that needs to be invested in infrastructure, and actually wondering how we're actually going to fund these. And surprisingly, you're actually seeing that less and less projects and less funds are actually going into this. And I think a lot of this has to do with the bottleneck is actually on the public sector side in terms of bringing the projects to market, developing the project to a state where it can be put to the market and bid. And it's not necessarily a criticism of the public sector, but I think it actually shows you the difficulty and the amount of work that actually has to go into developing a project. If there's a need for a road from A to B, there can be quite a number of questions of exactly where does that road need to be built? Should it go to the west, to the east, or whatever? Which communities should it go through? Which should it bypass? And this takes a lot of public consultation and so on and so forth. The other trend that is noticeable, though, which is potentially a positive trend, and you can actually see it quite clearly on the graph, is if you look at the blue sections of the bar, which is the ongoing increase in bond financing. Bond financing is a much more natural home for long-term infrastructure projects. Banks aren't really natural providers of long-term funding when you're talking 20 plus years. In some markets, you do still have a lot of bank funding being provided in the sort of 25-year plus, but that I think is going to be a decreasing trend because of the increasing bank regulation making that more difficult. And as the bond markets develop and more we start seeing them coming in and displacing banks, And what I've just put in the box at the bottom, which I think is a new landmark PPP refinancing, is the Victorian Comprehensive Cancer Care Centre in Australia. It was a development of or an expansion of existing hospital, but almost a development of a new hospital adjoining onto an existing hospital. The construction was actually successfully completed during the year, on time and on budget. And they very quickly refinanced it in the bank and the bond market, and they got long-term funding. The Australian banking market doesn't generally go beyond 5 to 7 year tenors, and here they interestingly secured a substantial tranche, 330 million of 11.5-year bank funding, and the bulk of the funding was 450 million of bonds that they placed both in the Australian domestic market and in the offshore market, principally the US PP market. It's a particularly interesting development for the Australian market, which previously has tended to focus a lot more on high-grade corporates and government debt. Right, then looking a bit at what we're seeing in the regions, the exception is the European project finance market, which actually had quite a strong first half. Although it did actually show a reduced deal flow in greenfield project financings, and there's a bit of a step down in PPPs. An interesting point here that has been shown up quite strongly is the involvement of Chinese banks in the European market. We've seen them for a while now having increasing appetite in the Asian and Australian markets, but this year has really marked them going into the European market in quite a big way, both investing in financing infrastructure and also following some Chinese companies that have been acquiring infrastructure assets in the European market, such as Beijing Enterprise Holdings, which recently acquired EEW, the big waste-to-energy company in the German market. The North American market was down markedly as well, and typically the trend continued similar to the Australian market, where most of the funding coming from banks is of the shorter tenors, principally around 7 years and out to a maximum of 10 years. What we're also seeing in the US market, though, is that there is a specialist niche of infrastructure investors developing that are building up portfolios of debt in infrastructure markets, and this is all part of the development of the bond markets. The Latin America market and the Asia Pacific markets both showed increases. In Asia Pacific, the Chinese market continues to be the biggest market, but it is pretty much closed to external banks, heavily dominated by the local Chinese banks. And apart from that, the other big player was Indonesia, and their market was largely driven by two huge deals: the Tangguh Train 3 LNG project and Central Java power station, a coal-fired power station, which perhaps also illustrates why there's a downturn in the financings and a difficulty in the public sector bringing these projects to market. Central Java has been in development for 5 or more years, and the principal delay there has actually been obtaining all the land that has been needed to build the power station on. So now you can imagine that if they're battling to acquire the land to build a power station, just how much more challenging it'll be to acquire the land to build a new airport or a new runway, or even a corridor for a road or a rail project. Right, I'd now like to turn to the principal topic of this evening, which is brownfield infrastructure projects. So firstly, I mean, what do we mean by a brownfield infrastructure project? Well, essentially it involves taking over an existing asset, not building a new asset from scratch, and then developing that asset over an initial development period and getting it into a specified condition. Now, this can involve increasing the capacity of it, as Shamala mentioned, earlier, the brownfield projects that she and I'd seen significantly earlier was the increase in capacity on highways, the so-called sort of four-laning, I think is they refer to in some markets. But also what it does very often involve is catching up on the backlog maintenance, where the government hasn't actually invested enough in keeping the asset in top quality, and that part of the PPP is actually to get the asset rehabilitated and get it up into a serviceable quality again and increase the service standards to the public. And then lastly, at the end of the concession, it involves handing the project back to the public sector in a certain specified condition with a certain remaining life on it. Now, as I was saying, we're seeing this increased trend towards PPP projects, and we think there is a lot of appetite for them. The challenge with these projects is that they do have a significantly different risk profile to a typical greenfield PPP project. And one of the key issues with brownfield projects is that, as I said in the beginning, you're taking over an existing asset, and you can't actually just close that asset. That asset actually needs to continue in operation, and then it is necessary to schedule the rehabilitation or upgrade works around keeping that asset in operation. And then lastly on this page, I've listed there a number of sort of variety of the sort of brownfield projects that we've actually seen, or certainly that I've seen, and it's quite a wide variety, although most of them are road projects. A number of years ago, the UK launched the so-called local authority road projects, which essentially involved taking over the whole existing road network in a town, and the scope tended to be quite wide. It would include all the signage, all the street lighting, and those were essentially catching up on backlog maintenance. There normally wasn't the capacity to expand those roads because they had existing developments around them. The UK, as far as I'm aware, has actually done 4 of those, and the reason I say as far as I'm aware, I've actually been based in Hong Kong now for several years, so I've sort of lost a bit of touch with that market. The first one, Portsmouth, was actually quite successful and seems to be going along well. Birmingham has actually had some problems, and there's quite a big dispute going on there between the private sector contractor and the city of Birmingham, and it seems to actually relate to the specified quality that the roads had to be upgraded to. Whether that, I'm not sure whether that relates to the entire network, or whether they had sort of 2 levels of standard for A category roads versus B category roads, and there's a bit of a dispute as to whether a different standard needed to be applied to the 2 of them. And the other 2, Hounslow and Isle of Wight, seem to have gone ahead all right. The next one is a very interesting project. Those of you who are familiar with the M25, which is the huge London orbital motorway, in about 2008, that was done as a public-private partnership for somebody to take over the operation and maintenance of the entire orbital road and do significant expansions to 2 major sections of that road. It is a big, complex project. Seems to be going quite well, but 2008 might actually give you a clue of being the year of the global financial crisis. And to actually bank that project, the state had to inject additional payments to provide cover for potential cost overruns, which effectively went through the cash waterfall and provided additional comfort to lenders if there was a shortage of funds because of cost overruns. To cover this, these funds would be available to debt service. If debt service was met, those funds went back to the state. So it wasn't actually available to go to equity as you would normally have seen in these cash flow waterfalls on a normal PPP project. The next 2 there, the A7 German motorway and the A63 motorway in France. fairly straightforward, single stretch of motorway having to be widened, and those seem to be relatively simple and have gone ahead quite successfully, and the Germans have done quite a number of these sort of projects. And then lastly, a major international airport project, the LaGuardia, which we'll discuss a bit more in later. I've got a bit of a case study I'll talk you through there. Right, now looking then at the key risks and issues that are associated with a brownfield project that you perhaps won't encounter on a regular project. The first one is what I've called operating leverage, and what I actually mean by that is the upfront capital costs relative to the ongoing maintenance costs tends to be quite low. And if those of you who've worked on a project know that one of the sort of key metrics of it is what is the debt service cover ratio. Is it 1.2, 1.3 times debt service, and that additional cover, the 0.2 or the 0.3, is really the lender's cushion to cover increases in costs. Now, when you take over an existing asset, invariably the upfront costs of rehabilitating or upgrading that asset is a lot less than building the asset from scratch. Whereas but the cost of maintaining it and operating it through the operating period is pretty much the same, whether you've actually had the upfront cost of half of it in the form of a sort of an upgrade as an example, or whether you've built the whole thing. And that actually means that a cash flow cover ratio of 1.2 probably doesn't give you the same cover of operating costs in a brownfield project that you would have of the 1.2 of a greater amount of debt. And that can lead to inefficient sort of funding structures, because the typical way of addressing the operating leverage is to provide a higher cover ratio. So that goes up to 1.4 or 1.5. There's additional cash. There's additional surplus cash, which means you need a higher proportion of equity. So your funding costs go up. So the overall funding efficiency of the project and the cost of it actually goes up for the state. The second key issue is the condition of the existing asset. You've actually got to do quite a good detailed due diligence of the existing asset to have a very good idea of the quality and the nature of the asset that you're actually taking over. And there is an increased risk that you don't discover something about that, and it ends up costing you a lot more. So this is usually passed through to the D&C contractor, generally not something that the lenders will actually take on. And this quite often is actually compounded by the fact that it can be very difficult to get all the existing documentation from the public sector authorities. Their record keeping may not be that good, and they may have built the asset over several years. Some of the records might be very old and might have been lost. The third point is a modifications regime. If you're taking over one of these sort of assets, it can be a dynamic environment going forward. The state may want to have the flexibility to add additional lanes. It may want to change the purpose of the asset, put in additional junctions or something, and that does get a bit more difficult. And there is a certain amount of scope to build in flexibility into these projects, to allow them to raise additional debt. It does make the funding a bit more complex, but there are limits to what you can do to this. You can't essentially halfway through the project sort of double the amount of funding that you would need. So you may need to have a specific early termination regime for the state to be able to take the asset back and then sort of re-tender it if there's really major works that they expect in the future. There isn't really a standard yet around this, and I think this is something we're going to see develop a lot more in the future. The next point I've raised there is interface issues. You normally find that, of course, you're taking over an asset from an existing authority. The road will possibly cover a number of authorities. You can have multiple public sector parties involved in the asset, and you also have to have much better cooperation between the asset operators and the contractors, because they're both going to be on site at the same time. they either need to agree how to work together, or then there needs to be some sort of a regime that when the asset is in the construction phase, it gets those parts of it get handed to the contractor, who is then responsible for managing the traffic or the ongoing operations, and then there's a regime for handing it back to the operator. But they both really kick off at the beginning of the project, rather than with a traditional greenfield project where you would have a very clear design and construct phase where the contractor has responsibility for everything and he builds it, and then when he's finished it, he hands it over to the operator. Right, now I'd just like to talk you through this new set of projects that are actually just being launched by the state of Victoria in Australia. And this is the Outer Suburban Arterial Roads Program. The Victorian government is focusing on the roads around Melbourne. If you have a look at the map there on the right hand side, pretty much in the center of the map is the Central Business District or downtown Melbourne. Melbourne is the fastest growing Australian city, and of course as it's growing it's expanding outwards, and what they've actually found is around Melbourne they've actually had a huge amount of development and changes in land usage, and they now need desperately to upgrade these roads. They are heavily congested and they're also not in the condition that they need to be. But the growth is actually stepping up in those areas, putting more and more pressure on the road network. So to alleviate this problem, they've come up with these Outer Suburban Arterial Roads Program. And what it actually involves is taking over specified networks of roads, the arterial roads. It's not like the local authority roads in the UK where you took over the whole road network. These are the main interconnectors that running through the outer suburbs of Melbourne. It doesn't actually include all the little streets where there'll be sort of suburban housing developments and that sort of thing. The state's objectives on this is to have improved customer service standards, speaking to people living down there. Apparently the congestion is terrible. They think it's also is having a cost on the economy. There'll be improved economic opportunities with making these areas more connected. It'll be more feasible for businesses located out there to be able to transport their goods to the port and the airport, or into the city more effectively. A number of these roads need to be widened to reduce congestion. And what they're identifying as well is that their maintenance program has been rather sort of haphazard, and they want to actually step onto a sustainable asset management project and bring in the benefits of whole life costing, that somebody taking over responsibility for those arterial roads will then have round about a sort of 20-25 year view on it and work out how to optimally develop and maintain those roads and lead to greater value for money for the public sector. Turning again to the map on the right hand side there, there's three packages of roads that they have identified. The one on the left hand side there, the western package, is going to be the initial pilot project that they're in the process of launching at the moment. Then they've got the southeast package there at the bottom right hand of the map, which is the next one that's expected to be launched. And then thirdly, there's the northern package, which they're still in the process of developing. Now, looking at the next page, if you can look at the expected scope of the project. Just before I talk you through the two, if you look at the left-hand map and you see the green bits of road there, those are the roads that actually need to be expanded. And then if you look at the right-hand side, that's the entire network that they'll be responsible for. And I think that quite graphically illustrates the operating leverage to you, that you're actually building a significant, your upfront cost is for a significantly smaller portion of the network than the network that you will be maintaining. The initial development works involve 8 arterial roads that need to be upgraded. There needs to be a lot of improvement work done on the pavements, a lot of resurfacing and rehabilitation, and some structures need some important attention. One of the key issues of this is going to be working in a live dynamic traffic environment, that they are going to have to close roads. These are all single lane roads at the moment, and they are going to have to manage the traffic so that they minimize the disruption to the public. So you have to very carefully work out which roads you can work on at the same time, which ones are the most congested, need the most urgent attention, and then phase the work so that you can actually keep traffic moving across the network as you're doing the overall development. Then the initial development period is expected to last about 3.5 to 4.5 years. Then looking at the maintenance, that is a fairly sort of standard maintenance package. It'll be the routine maintenance, road repairs, inspections, responding to accidents, the roadside maintenance in terms of looking after cutting the grass, clipping the sort of trees back. It also includes periodic maintenance, which is every sort of 8 or 15 years, depending on the sort of quality of the surface that you've actually put down. You have to do a major resurfacing of your road. And interestingly, this actually excludes all traffic signals and street lighting and electrical systems and the ITS, or intelligent transport system. Now, these were all things that were actually included in the UK local authority road projects, so they've actually trimmed back the scope quite a lot here from what had previously been done in the UK. Now, looking at the current status of what is actually happening at the moment is they've started the bidding process for the first project, the western one. There's a good number of parties that have expressed an interest, contractors, infrastructure investors, as well as the road operators. So it does look as though what they packaged is actually getting the attention of the private sector, who are showing a lot of interest in this. Those bidders are believed to have formed themselves up into 4 groups, and the state's expected to shortlist 3 bidders to actually bid for this project. The initial expressions of interest have to be submitted tomorrow, and they're expected to announce the shortlisted bidders and start the bidding process in Q1 next year, and they're hoping to then select the preferred bidder and actually have the works commencing by the end of next year. So it's a reasonably challenging program, but certainly achievable. Some of the key challenges specifically associated with this project is that the area where it is does have difficult and challenging ground conditions with basaltic clay, and the problem with this is it expands quite a lot when it gets wet, and if you don't actually control your drainage problems, it can actually do quite a lot of damage to the road surface and, of course, lead to a lot of increased costs. The second one that I've already touched on previously is the scheduling of the initial improvement works. Actually working out which roads you can close and which ones you can work on simultaneously and minimizing the disruption. And then thirdly is actually establishing the condition of each of the roads. They've been built over quite a wide period of time, and certainly from what I'm hearing at the moment, they are not actually in very good condition. I think part of that has had to do with backlog maintenance that hasn't been done, but also the increasing congestion, and there's been a significant increase over the last several years in the amount of heavy goods vehicle traffic on those roads. So this will be an interesting process to watch over the next year, and if you're interested, you can keep an eye on it in progress in the media. Right, then lastly I'll turn to the LaGuardia Airport Terminal B redevelopment project, which, as I said, had been done by my colleagues in New York, and it just closed recently. So On June the 1st, the LaGuardia Gateway Partners consortium actually won this project. It's a fairly sort of typical consortium, including Vantage Airport Group, Skanska, the big construction company, and Meridian, one of the major international infrastructure investors. The airport is actually held under a lease with the Port Authority, and that's not actually a typo. It is the Port Authority of New York and New Jersey that is the public sector party opposite this. They manage the ports and the airport. The project actually involves taking over the existing Terminal B airport, basically demolishing it and the related structures around it, and then building a whole new Terminal B. It also involves some other ancillary improvement works around the airport to improve access and that, and building a whole new central arrivals and retail works. The construction obligations are passed through to the construction company, as has been done sort of fairly typically, and it's a 4 billion construction project, so it's very substantial, and it's going to be scheduled over 74 months, so over effectively a sort of 6-year period, which is pretty long for a construction project in a PPP project. And it's going to be undertaken in 6 phases, and I think that gives you a clue about the issue that they're facing here, which is actually operating in a live environment. They have to keep the terminal and the airport operating over this period. Interestingly enough, about 80% of the project revenues are going to come from the airline charges, and only 20% is expected to come from commercial concessions. This tends to be more the case with American airports. They don't tend to have as much retail development as you'll see in the European market. A number of European airports that I've actually seen, and something like Sydney Airport probably has about a 50-50 split between the retail and commercial revenues versus the aeronautical revenues. Part of that is also because the parking revenues are being kept out of this project. That is actually staying with the Port Authority. Right. If we look at the next slide, there's a picture of actually what is going to be built and phased. There's the new facilities that are actually going to be funded by the private sector, and there's partial funding from the Port Authority. You can see the new central hall towards the bottom there, and then the new improvement works, which are going to be funded and handed over to the Port Authority, which is the roadway network and the road access on the left-hand side of the picture there, and the new west garage in the top left-hand side of the picture. If you look briefly at the construction overview, there you can actually see how they've had to phase it, starting with the head house, then moving to the Concourse B East, then Concourse B North, and then when that's completed, moving to the Concourse A North and Concourse A West, and the whole process is taking 74 months. Principally, that is working around keeping the airport operational. This is just a brief overview of the funding structure, and a few points again unique or typical of the US market that I'll actually touch on. The bulk of the funding is actually going for the new Terminal B, which is a fixed price contract that they've actually secured from the design and build joint venture. Another thing I'd like to draw your attention to is towards the bottom of the uses table there. There's 90 million of contingencies, so there's going to be an element of revenue and that coming in over the period. You'll see at the top there's reinvested operating profits, and there is potential for other costs that need to be incurred or overruns that wouldn't necessarily be associated with the new Terminal B that would have to be picked up by the contract. So there's a reasonably substantial contingent funding amount there of 90 million, and that of course always does add to the cost. Looking at the right-hand side there, two different funding options were considered, and this is fairly typical of these sort of projects in the US market. They've actually got very sophisticated bond markets, and there's also a number of different products that they can place in the markets, and some are tax exempt and some have other sort of tax advantages. The pricing of these markets tends to move independently of each other. So one of the challenges for the financial advisors on these projects is they need to run all these different funding options in parallel and are continually testing which one is the most attractive. And then finally, as they're coming towards closing, they'll then sort of shortlist it down to two, and sort of, literally very close to actually placing it in the market will actually calculate which one is the overall most cost efficient and go with that. And what actually happened in this project was that the option one with the 2.35 billion AMT tax exempt bonds and 150 municipal taxable bonds, which means the investors will pay tax on the interest they receive on those bonds. I won't spend too much time on the next slide, but that shows you all the tranches that were actually placed in the market. A portion of the bonds issued were guaranteed by assured guarantee. It was 410 million of that, and you can actually see how the amortization profile was managed through the different tranches, starting with the first one being repayable on the 1st of July 2024. That was starting with the 2016 B bonds, and then the A bonds are then start amortizing once the B bonds have been replaced and the last payment being made on the 1st of January 2051. Then finally, what I've got on the next slide is just the sort of risk allocation. Fairly typical. Project company obviously responsible for the building the terminal. They are taking full revenue risk on both the aeronautical and non-aeronautical revenue, and of course full operating risk. They're responsible for operating the asset over its life. The Port Authority, as I mentioned earlier, retains all the parking revenues and risks. They also responsible for certain delay compensation events. Force majeure typically stays with the public sector. They are also in line to achieve a certain revenue share, depending on what the overall revenues are in the project. Revenue share can also help de-risk the revenue element that the private sector is actually taking. And then the last point I'd just like to mention is they do take the risk of a break of the city lease, and what that is the city of New York is the head landlord that leases the airport building to the Port Authority, and then the concessionaire in this case is actually a subtenant of the Port Authority. Right, then lastly, in conclusion, I think as there's increasing pressure on public sector budgets, it can be a lot more cost effective to improve and upgrade existing assets rather than building new assets. Also, in a lot of cases in developed countries, there typically isn't the land to just expand outwards and build new assets. So I think increasingly we're going to see more and more use being made of these brownfield infrastructure projects. As we've seen in Australia, and certainly my experience of the other projects we've seen in other markets, is there is good appetite from the private sector to be involved in these sort of projects, notwithstanding the different risk profile. I think they certainly do have the expertise to get their heads around and understand the different risks inherent in these projects. To date, as I've sort of touched on earlier, there has been quite a variety of different projects. Some of them have maybe been a bit too involved or a bit too sort of complex. But I think it's going to be some time before we see a fairly standard model emerging for brownfield projects, and I think the sort of standard will obviously be different for airports and for roads. But I think what we're seeing developed here with the state of Victoria, I think, is an interesting model, and one that could be rolled out not just in the rest of Australia, but also in the rest of the world. You're not necessarily taking full responsibility for a network of minute urban roads. You're actually taking over the major, more important arterial roads and suburban interconnectors. And it's interesting that it is the state of Victoria doing this. They do actually have a long history in pioneering PPPs. They were one of the first parties that sort of got PPPs going in the early 90s, even before the UK market. And I think going on, one of the key challenges is when the public sector is formulating these brownfield projects is going to be to package them in a way that they actually get the right balance or don't get too much of an imbalance between the upfront investment and upfront construction works and the ongoing operating cost. And I think various mechanisms can be developed to help get that balance right, so that the state is actually getting the benefit of an optimal funding structure. One of the disadvantages with PPPs is that the private sector funding associated with the PPP is more expensive than state direct borrowings, understandably so, because the lenders are taking a lot more risk. But to the extent that you get that balance out of kilter and you actually are not able to achieve the levels of leverage that we've typically seen in the greenfield PPP projects to date, it's going to just exacerbate that cost. Right, well, thank you very much. I hope you've found that presentation interesting, and if you have any questions, I'd be happy to answer them or try.
Gabby, this is Xavier. It seems that we have a technical problem with Shamala, and she cannot ask the questions. So if you could through some of the questions while we wait for Shamala to
Sure. Okay. Can everybody hear me? I started trying to talk and then recording okay. There's one question here is for the arterial roads project, what payment mechanism is used? The payment mechanism is still under consideration. The expression of interest documents haven't given a lot of detail on it, but it's what it's expected to be is effectively lane availability, which is what you've seen on a number of availability motorway projects where the private sector is paid per lane kilometer that is open to traffic based on the time of day. So if they close a lane to do maintenance works, the deduction or the lost revenue is a lot less if it's at midnight than if it's at the peak period. And it's also expected to be connected to the condition of the road. There will be certain tests about the road surface condition, and that will also impact the payment. They haven't also yet specified what will be the starting condition that the roads need to be brought up to during the initial development period. And of course the payment mechanism will need to be linked with what is the starting condition. Okay, I can pick up another question here. It says, to what extent do private investors as well as operators take into account climate risk when evaluating a potential investment? Also, who is responsible for providing this information, be it climate or disaster risk? That actually largely depends on where the road is situated. The roads in Victoria, around Melbourne, climate risk isn't a particular issue. Drainage obviously is important, as I mentioned, with the basaltic clays, which can expand a lot if they get wet and there isn't good drainage. This risk is taken by the private sector, and it's really up to them to take a view on the extent to which climate or adverse weather can affect them. There was a project earlier in the year we worked on in New Zealand, and actually there you just cannot work in the wet season. So effectively the project involves working for 6 or 7 months of the year only, and then having to stop when they cannot do any sort of bulk earthworks while it's during the rainy season. Okay, one here I'll try my best to answer. It says, what about mining and energy sectors? There's ongoing increase of government and private partnerships, but they seem not to be referred to under the umbrella of PPP. Yeah, I think actually energy projects are quite often done as PPPs, like the power stations. I think the Central Java power station that I referred to earlier was a public-private partnership. They do tend to be considered maybe in more of a sort of sector of their own. They've got a slightly more distinct structure with power purchase agreements. Mining projects tend to be much more the preserve of the private sector. I'm not actually on the mining side myself, but I have had some involvement on infrastructure projects where the development of the infrastructure is actually connected with a mining project, and I was involved on the development of the Roy Hill iron ore mine in Western Australia, where my colleagues on the mining side focused on the mine and the processing plant, and me and my team actually focused on the 400-kilometer rail link to Port Hedland and the port handling facilities. And that was all wrapped up in a single project sponsored by the mining company. So it wasn't really a PPP as such. There wasn't any direct involvement with the other than obviously getting your permitting from the state. There wasn't actually the state actually partnering with them. They gave the permissions and then left it up to the private sector to develop and finance it, and that we are really reliant on the successful mining and export of the iron ore to repay us. Can you please give your opinion wherein there have been cases, specifically in road projects, wherein one country's operators intends to invest or operate the road project located in a foreign land? In that scenario, the risk factors increase drastically as the government policies and the implementation structure modality may vary. What shall be the safe way or measures should be taken care of, even if the operator has detailed technical due diligence carried out? Yeah, that is a good question and an interesting question. It's not often that I've been involved on cross-border projects. The one specifically that I was the Maputo corridor, which was a toll road connecting a town in South Africa called Witbank with Maputo, which was the capital of Mozambique on the east coast of southern Africa. So the road went through South Africa and Mozambique, and it doubles up a lot of your complexities. You're dealing with two public sector authorities there, with the Mozambique road authorities and the South African road authorities. You're collecting tolls in two currencies, the Mozambican meticais and the South African rands. I think what made the project there a lot easier is it was probably about 80% South African and 20% Mozambican, in that most of the distance covered was on the South African side. So most of the revenue came from the South African side. and we were able to fund the project entirely from the South African banks. The equity investors then actually took the risk of the tolls being collected in Mozambique and being repatriated to cover the South African debt costs, or be the return to the investors in the road, which were a couple of South African companies and some international funds, and they took the risk of what was the conversion rate, and also whether the funds could actually be remitted from Mozambique, because Mozambique had quite tight exchange controls, and although there wasn't, eventually you would get your money out, they actually did tend to ration when and how people could take their money out of the country. Xavier, should I look at taking another question?
Yes, please.
Okay, the new one here is how critical is availability of equity finance from project sponsors to unlocking debt finance in infrastructure finance, and how do you see these evolving over the coming years, i.e. will more equity be required to unlock debt or vice versa? The short answer there is yes. Equity is critical in a number of respects. First of all, if you recall what I was saying about the cover ratios, there's the debt always needs a certain cushion of additional funds in the base case that are there to cover increased cost or contingencies. These surplus funds is actually what goes to equity. So equity takes the risk of there being an increased cost. If you can't actually raise enough equity there at a reasonable return for the required cushion of funds, you get an inefficient funding structure. The second point is that debt holders always want the project sponsors, the people who are going to actually build and operate the road, to be investors in the equity as well, so that they have an incentive to actually make sure the road actually works. You don't want to get a bunch of contractors in there are going to build the road, be paid for the construction, and then they actually have no incentive or no interest in making sure that that road is actually capable of operating over the concession period at the costs that have been predicted. The debt holders don't typically expect the operators and builders to have 100% of the equity, but they do expect it to be a meaningful stake. I would guess sort of minimum 20 to 30%, depending on the risks of the project and where it is. But you are increasingly seeing more and more specialist infrastructure equity investment funds coming up, and not just in the developed world, but also in emerging PPP markets.
Thanks, Gavin. I've been talking with Shamala. She has some technical problem to connect through audio conference and through the meeting room. So we can take one more question before we do the closing. So you can choose one.
Okay, here's what. Have you seen any project where disaster risk, e.g. hurricane, earthquakes, is insured by private insurance companies? Yes, quite often. The projects in New Zealand did have, and Christchurch did have that disastrous earthquake a number of years ago. There is an element of insurance risk available in New Zealand. It of course does have a cost associated with it, but you will typically find that those sort of risks in most areas where there is a sort of smallish chance, shall I say, of those things happening, of that being insured as well. The issue that you do have with these types of insurance, you've got a 20 or 25 year operating period. if you have a major natural disaster, you obviously haven't taken out an insurance policy for 20 or 25 years. So you have a major insurance policy, it pays out in year 6, say, you will find in year 7 or year 8, your premiums are actually going up substantially. Very often you do actually find there is a risk-sharing regime on insurance costs with the state. And the state sometimes does take the role of being a sort of insurer of last resort if for any reason insurance isn't available. And in those cases, the state takes what is considered a reasonable amount that should have been payable or historically had been payable for the premiums, and then they will actually take that risk. Soon after 9/11, actually, a lot of banks became a lot more nervous about insurance risk, and you actually found when you were running sensitivities on projects, lenders were asking, say, for a run a sensitivity with a 10% increase in general in most costs, but a 20 or 25% increase in insurance costs.
Thank you very much, Gavin. It has been a really interesting presentation, and we had a fantastic interaction with the participants with a lot of questions that sadly we don't have enough time to go through all of them. So, but before closing the webinar, I would like to ask you, want to give you the last opportunity to share your final reflections on the presentation.
I must admit, I'm quite impressed with the number of questions that people have actually come up with, and I think it does sound as though everybody found it quite interesting. I think they can get the presentation down themselves if they want to have a look at things, and certainly if anybody wants to email me any questions, I'd certainly be happy to consider them. And thank you very much for participating.
Thank you very much, Gavin, for this fantastic presentation, and thank you also to our audience. The presentation and the recording of this webinar will be available in about 24 hours in our website, as well in our YouTube channel and iTunes. You can click on the different links that we have right on the screen. Thanks again, and have a wonderful day, afternoon, night, wherever you are. Goodbye.